Hello and welcome to my channel. Monish Pabrai invested $79 million in the company Valaris. In this video, I will explain what Monish sees in the company and why it is an interesting investment. I will analyze its business model, moat, balance sheet, valuation, and finally tell you if I will invest in the company. Let's begin with the business model. Valaris Limited is a provider of offshore contract drilling services for the international oil and gas industry. They own and operate a fleet of offshore drilling rigs. These include jackups, semi-submersibles, and drill ships spanning shallow water to ultra-deep water operations. They provide services for well program requirements across all water depths. So apart from just rig rental, in effect, they provide the supporting operations like drilling wells, handling the logistical, engineering, crew support to operate rigs offshore. They also engage in rig management, maintenance, upgrades, crew operational support. Their fleet must be maintained, modernized, all the rigs retired, scrapped, or sold. So how do they make money? Valaris' revenue model is relatively straightforward. They charge clients a daily rate for a rig in operation. The rate depends on the rig specification, if it's a jackup, drill ship, etc., etc. The water depths, whether it's ultra deep, how technologically capable it is, and risks involved. Revenue depends on how many of their rigs are operating versus idle or in maintenance. If utilization is high, revenue is steadier. If rigs are idle, they generate less revenue but may still incur fixed costs. They secure multi-year contracts often in advance, which gives them future revenue visibility. This includes contract extensions, new contracts for specific rigs. Valaris operates globally. They have high-value customers, some of them are shown in this figure. Valaris is not the only company with such a business model. There are a few other competitors. Pause the video and read about them if you are interested. Now, before investing in any company, it is important to understand if it has a moat. Valaris has fleet scale and quality. It has one of the largest offshore drilling fleets in the world. Rigs can be moved to where demand is rising. Contracts can be matched to specific customer needs. A modern, well-maintained fleet is more attractive to oil companies because downtime costs them millions. This creates an edge over competitors with older rigs. Oil and gas majors prefer working with companies that can service multiple regions and comply with varying regulations fewer vendors can manage in this condition. Furthermore, long-standing relationships with super majors like Exxon, Shell, Chevron, BP, Total Energies, Petrobras, Saudi Aramco, etc. give repeat contract opportunities. Last but not least, they have a good financial position. A clean balance sheet allows the company to survive downturns better than weaker players, while still investing in maintenance and upgrades. Many competitors, especially smaller ones, lack this financial flexibility. This is a list of some of the oil rigs companies that filed bankruptcy in the last 15 years. As you can see, many companies could not survive the cyclicality of the market. Interesting, Valaris is one of those companies, but this was back in 2020 and the company is revived now. So Valaris does not have a wide moat like software companies or a utility might. Instead, it has a narrow moat, relative moat, that gives Valaris an advantage over smaller, less diversified rivals, but not absolute protection from industry downturns. Now let's have a look if the company have a future by analyzing the energy needs for the future of oil and offshore drilling. The energy demand is growing and growing. Workers are replaced by robots and automations that requires energy. Bitcoin mining requires a lot of energy and so does AI data centers. Oil demand isn't going away quickly. Offshore provides large, long-lived reservoirs, especially deep water, which can offset declines better than smaller shale wells. Many deepwater projects can now break even at $40 to $50 per barrel, making them competitive with shale in some cases. Many scenarios still show oil demand at 20 to 30 million barrels per day in 2050. Offshore will remain part of that mix, so Valaris do have a future. Now let's check the balance sheet of this company. As you can see in this chart, the company have $1 billion of debt and $500 million in cash, which results in $500 million in debt. The company's cash flow is $230 million, so it takes a bit more of 2 years of cash flow for Valaris to pay its debt. Now before you get scared of the debt, let's jump into valuation. Since the company's cash flow is all over the place, the best way to value Valaris is by its assets. In other words, if you buy the whole company and sell all its assets, how much money will we get? So Valaris has 35 jackup, each costing you around $200 million. They have 13 drill ships, each costing you around $800 $800 million. And they have 5 submersible platforms, each costing you $400 million. The lifetime of each asset is between 20 to 30 years. If the lifetime is 25 years, then the price should be deducted by 4% every year. Now let's be conservative and assume the selling value is half of the new value, which means each asset is 10 to 12 years old. Note here they have a lot of newer vessels. This is only to be conservative. By doing the calculations, the assets value that Valaris owns is $9.7 billion, which is 3 times the company's market cap. So based on the asset analysis, the stock could 4x for the company to reach its asset value. Now let's look at this from the free cash flow perspective. If the daily rates of the ships are $400K, which is illustrated in scenario 1, the company will make $300 million per year. Now if you look at the daily rates for the last couple of years, $400K is the average daily rate, which means it could go higher. If this happens the next 10 years, the company decided to return shares to shareholders by doing shares buyback. As you can see in this chart, they have been buying back stock whenever they can. If they generate $300 million per year and buy back stock for 10 years, the company will go private and the stock price will skyrocket. Now why did the cash flow fluctuate so much the last couple of years? The reasons are reactivation costs of rigs. Valaris has had to spend substantial amount to reactivate rigs that had been inactive. These reactivation costs include things like preparing drill ships for new contracts. In Q4 2021, for example, rigs deactivation costs jumped to $34 million, as several rigs were prepared for contracts in 2022. Another reason is lower operation cash flow in some periods due to utilization and day rates and downtime. Utilization of rigs has been uneven. Some rigs are idle, some underutilized. That reduces the cash flow from operation. Reactivation periods mean rigs aren't generating revenue while costs are incurred. In this chart, you can see the cost for managing and maintaining rigs. Luckily for the future, Valaris have a high utilization rate of their rigs, as you can see in this chart. So in total, to summarize, the company has around $10 billion of assets, while its market cap is 1/3 of that, and it is buying shares aggressively. If it continues buying shares like that, the company will go private in 10 years. In this scenario, the stock will skyrocket. This happened when Monish Pabrai bought Rezas, also an asset play like Valaris. As a risk factor, the operating costs of rigs are very high and can eat the cash flow of the company if the rigs are not rented. The price of the stock have a high correlation with oil prices, which are very volatile, as you can see in this chart. I find this stock interesting. Maybe I will invest 1 or 2% of my portfolio in this company. What do you think of this stock? Are you willing to invest? Thank you for watching.